Hello, this is Coach Mike from WinningStockCoach.com. I'm going to get started with my weekly market overview video for the trading week ahead, the week beginning July 27th, 2015. Taking a look here first at a weekly chart from the SPX, that's the S&P 500. We actually came up and got within our 0.5% of our first upside target before pulling back very, very drastically this past week and really resting right above our support point, which would be 2076.78. So right now, as we approach the week ahead, we've kind of got a little bit of territory. You know, I've said it for a little while. We had an intermediate target we hit down here, but I believed we'd get down to this 2022.07. I still think that that could happen, but I think it's a rocky road and it's not one worth any type of long-term trade in, even to the short side. We've got a couple points we could hang up on. You know, should we lose that 2076.78, we could see a retest just like we had down here, and even a weekly close down into this area of 2053.40. I think that's just going to be better traded as a series of shorter term trades, not necessarily day trades. You know, this past week in our chat room, members of the Coaches Roster newsletter, we did a series of trades on the SPY, which actually had some buys and sells nearly every single day this week through the downturn. It was actually quite successful for us as well. But we traded a week out, allowing us to do overnight holds on put options. So it was pretty good for us overall. Anyway, should we hold this support level? Should we hold that 2076.78 and start to make an up move? Understand that we've got really, you can really kind of see the multiple tops here, but if I go to the daily chart, that's where it's even more incredible. You know, over in here, really, really close. You know, to say literally within a 0.5%, maybe 1% of this overall high, we've really had 1, 2, 3, 4, 5, 6 tops, and within a 0.5% of it, 1, 2, 3, and 4 tops. So a bit tough right now, to be honest with you, on where we could go. But as we go back to that weekly chart after seeing all those tops in the same spot, understand that at this point in time we cannot target anything higher than, you know, really 21.25, we'll say. You get up to 21.25 and even get a glimpse of pullback, you've got to sell. You'd be better off with all those tops there. You'd be better off selling there, and then if it does break out above there, rebuying, even though you might pay a little bit more than what you sold for. But at this point in time, what the charts are telling us is we're really struggling to get over a very specific resistance value. And we've got another good week ahead of a lot of earnings, and then it'll start to kind of trickle off after this week. But I've actually been quite disappointed with earnings overall. You know, Apple beat on earnings last week, but stock didn't act like it did. They missed on several of their revenue chains, and they were down on iPhone sales and Chinese sales. We saw the bank stocks the week before. The bank stocks, many of them, not all of them, beat on their EPS estimates, but every single one of them missed on revenue expectations. You know, the only way to do that is to cut corners, cut jobs, close locations, stuff like that. So we've really got some manipulated numbers that even where it might say they beat on their earnings per share estimates, there's so much else factored into that that truthfully, when you read through the earnings reports, it's kind of a lot of not good stuff. So we need to know where our support is, know where our resistances are, and quite literally right now, just trade between the lines with not a lot of hopes of anything longer term. Over now to the DJI weekly chart, that's the Dow Jones Industrial Average. You'll actually see that we have now closed below that weekly swing low point and formed on this weekly chart what is commonly known as a head and shoulders pattern. It's commonly considered by technicians as the most bearish chart pattern. Um, where you typically target on a head and shoulders is a retest of that prior low, which would be down here, 17,164.95. Couple Fibonacci targets that may give a bounce in here, and then your resistance point would be what's called that neckline. That would be this horizontal swing low that it closed below, 17,712.66. So, even if we had a little bit of an up move to start the week, if that up move did not break this resistance point and begin pulling back, that would actually be your short entry for probably, really, I would say that 17,251 is where I would be looking to target for, and probably something that wouldn't even last the entire week still. So another short-term trade. Now, should it give up this 17,164.95? Then what I would be looking for personally, before even getting into anything longer term, would actually be for the next up move. The next up move, I would be watching very, very cautiously for any resemblance of a pullback to begin scaling into longer term short trades. Now over to the RUT, that's the Russell 2000, the small cap index. Very, very similar pattern here to what we saw on the DJI, this head and shoulders pattern. Closed just barely below that neckline, but we do have some more soft resistances, I guess you'd call them, here in the way, or soft supports that would be in the way of a short trade. First off would be 12.15.21, a prior swing high, which you can see after breaking here, it held it a couple times here in the past. And then a Fibonacci target at 12.05.88. So again, even though the markets are really starting to set up bearish patterns, they're still indicating shorter term trades at this time. Now, if we do get that failure of that 12.15.21, I'd probably use the 12.05.88 as a failure to enter a few swings on small cap stocks. And if you look through those that have already reported earnings, there are some small caps not doing too well. And then there's just a bunch of biotechs getting bought out and doing buybacks and stuff like that, which is kind of odd that we saw such a drawdown in the RUT, considering the number of biotech stocks within the Russell 2000 and what we saw the biotech stocks doing this past week. So if you're going to take a short trade, I would probably say you've got to be very, very short term in your mindset. If you're going to trade like the IWM, an ETF that is a tradable ETF for the Russell 2000. Finally, now the NDX, the NASDAQ 100. We talked about this in last week's video at our 46.90 target point. We got actually just barely above it and rapidly pulled back. But where we pulled back to is, you see the support level of the higher end of this consolidation. We're going to want to use a support of 45.3678. That's going to be our support point. But if we see those head and shoulders breakdowns in the other indices like we are starting to see, then I believe what you look for is a rapid fall on the NDX back down into this area around 4,300, but as a lagging chart would still have to make a bounce up into this 4,500 range to give that right shoulder, with this most recent high serving as that head of that technical pattern, before it would be jumping on that bearish train for a longer term trade. But the drawdown from it does make it right now the best chart if we get further downside. Would make the technology stocks the best to jump in if the rest of the indices begin hurting badly. We'd want to look at stocks that have shot up, like Netflix even though the news that it shot up on was great, like Amazon, which just had pretty good earnings, but really all they did was show a profit. And for the record, I'm long in Amazon. I own a very decent sized position, even though I know and recognize it's a cult stock where the fundamental value does not support the share price. And I don't recommend people be long in very many or even really more than one cult stock, but that's the one I'm long in. And I made sure to sell covered calls and buy in the money puts on Friday because the downturn kind of scares me a little bit. So anyway, as you take a look this upcoming week, understand we're dangerously close to some very critical support areas. And on the Dow Jones Industrial Average, we've actually surpassed that critical support area. It may have just been because of an overdrawn down day on Friday, but if we open up still below those critical support levels tomorrow, the trades are actually quite easy to make. If you're looking at the short side, don't so much concern yourself with how much it fell on Friday and thinking you missed it. If it's failing the next support point, then it becomes a resistance point and very easily allows you to assess the risk of the trade. And also remember, this isn't some video that's just trying to convince you to be a bear. All those other indices that were right at that support point, let's just remember two assumptions that as traders we need to make. That support will hold and resistance won't be broken. The best trades, the momentum trades, are created when those assumptions fail. But for all of those that are sitting right at their support levels or close to, your assumption first should be that that support will hold. Whereas you quickly revert into momentum trade mode should it fail. This is Coach Mike from winningstockcoach.com, wishing you the best of luck in your trades in the upcoming week, and God bless.